think Credit Suisse was particularly interesting for a few reasons. One is Credit Suisse is so iconic for Switzerland itself, right? It would be very hard for Switzerland to let another firm other than UBS take them over. It would kind of be a black mark on Switzerland itself. Not only that, if you think about all the history of Swiss banking, right? The idea that all of a sudden now a French bank or a US bank is going to control the private bank and all the secrets that go along with a European private bank, or a Swiss private bank, that just was, to me, it was never going to happen. The biggest surprise for me for Credit Suisse was honestly that it didn't happen earlier. Like they've been a dead man walking for a couple of years, if not 10 years. But it finally came to be. And I think this populism stuff does, it is part of it, and the fact that the Swiss government, kind of forced the sale on a Sunday and, changed the law in order to get it done. There was an element of populism in that. They wanted it to go to UBS. They didn't want it to go bankrupt. They didn't want it to go to an outsider. There was the biggest investor was from the Middle East. And so, there's all this stuff that goes into it. But the idea that banks and governments are somehow immune from populism, banks more than anything, but banks are one of the most they're not immune from populism. They're one of the most affected by populism, I would argue. You go back through history, there's been a number of problems that have come up with banks, and populist answers or responses were taken.
Yeah, you know what, Brent? What really struck me about Credit Suisse was why now? Because I agree with you. How long have we been talking about Credit Suisse being a troubled bank? It seems like I can't remember a time when it wasn't a troubled bank, right? It goes back forever. So what happened over the last 10, 12 days that made the Swiss authorities say, today's the day we have to step in? That's what I get back to. This is more than just Credit Suisse or Silicon Valley Bank. There was something very Bear Stearnish about the way this was put together, sort of the last minute, that had me thinking, all right, did they run out of collateral? Was there some form of liability run beyond depositors, beyond, not being able to fund everything up? Something happened that triggered a government response, because I think you guys are both right. There is a larger issue, especially with Credit Suisse, about we don't want to take it over. We really, really, really don't want to do that. But then all of a sudden on a Sunday night, they said, we got to do this. And I think that's what's really spooking the marketplace, is that this isn't really about that single bank, is that the system itself is reevaluating everything in it and saying, you're Credit Suisse, you're a troubled bank, goodbye. I'm done with you. You're Silicon Valley Bank, you're screwed up your bank, you're experiencing a deposit run. You know what? We're going to cut you off too. So the system is slow. It's the old analogy about the tide rolling out. The tide is rolling out, and we're starting to see who's been naked the whole time. Well, nobody's surprised that Credit Suisse was naked. That's not a surprise. Silicon Valley Bank, maybe that was somewhat of a surprise. But I think the overall point here is that the tide had receded so much. And let's not forget, it was in the middle of March, which is when the tide is at its low point anyway. So that's. Well,
I think the other thing that's interesting, for me, of course, I've obviously get a lot of questions regarding the dollar and all that, all that goes along with that.
You've kind of made yourself the target for that.
But what's really happened lately is the U.S. raised rates and they blew themselves up in the process. Well, yes, I'm not saying that they didn't, but let's not forget that, the whole Cantillon effect, right? Like whoever's closest to the money benefits the most and they get hit the last. Well, the idea that the U.S. got hit first here is completely incorrect. I mean, for God's sakes, the Bank of England had to save the gilt market 8 months ago. The Bank of Japan had to come in and save both the yen market and the JGB market in the same week back in September, right? The ECB, 9 months ago, when they first started raising rates, in the meeting where they first raised rates, they also set up a facility to buy periphery bonds to keep their yields down. So this isn't something that just popped up out of nowhere and hit the US first. This has been coming for a while, and the signs were all there. Now, why did it happen in the last 2 weeks, and why did it, and again, this isn't like at a bank level, this is a country level, right? Like Europe, I mean, England itself was in trouble. The ECB was in trouble. The Bank of Japan itself was in trouble. China cut reserve ratio requirements, I don't know how many times last year, and had to get involved in the banking system to keep that going. Credit Suisse has to save one of their marquee, or Switzerland has to save Credit Suisse. These are country issues. It isn't just like a small little industry on the periphery of the global economy. These are the countries, and they're not small countries. These are major countries. And so it is a systemic issue. And nothing underlies an economy more than the banks and the money. And it is a monetary banking systemic issue.
Yeah, I mean, that's a really good point too, Brent, is that people will always say, well, this just came out of the blue. This was totally unexpected, when it was anything but. We've seen it coming the whole way. And, I think the problem is nobody knows that they should connect what happened last September in the UK gilt market with this overall. I mean, what does that have to do with Silicon Valley Bank? What does Silicon Valley Bank have to do with Credit Suisse? What does any of that have to do with the fact that Pakistan was out of reserves in early February? Because you're right, it's not, we're at big level stuff that's been going on, but for most people, they can't say, well, there's a monetary system behind all of these things that connects all these dots. So that when we're saying the tide was coming out, that's what we mean. The tide was going out last year and revealing the gilt market was in trouble for a variety of reasons. Pakistan, Sri Lanka, all these major countries that are having monetary issues that stem for a lot of these systemic issues that go back into the 2020 and 2021. So that's what we mean. The tide has been coming out for quite some time. And that's what the markets have been saying. That's what's been driving inversions, that there was going to be a time when the tide went out too far and it created something like we're seeing now, which looks a lot like a systemic crisis, not just a isolated instance of a couple bank failures, but a lot bigger than just that.
What's also interesting, let me say this before I forget,
Okay,
and I know
please.
There's probably a lot of people saying, well, how did the markets stay up, and how did equities rally so hard from September into March? And I know it was a year ago when the curve first inverted, but then if I remember right, it kind of leveled back off, and then the real inversion came in June, July timeframe. You know better than I do, Jeff. And so people would think, okay, that's an automatic sign of a recession. It always leads to a recession, But the reality is every time we've had a curve inversion, it usually takes 9 to 12, 18 months before that curve inversion leads to a recession. And usually what happens in that 9 to 12 months is that equity prices go higher. And I don't know why that is. I just know that it is. I don't have the answer. I don't know why it should happen. I just know that it usually does. And so it's pretty interesting that the curve inverted last summer, and here we are 9 months later, and all of a sudden we have the market's kind of shaky again, and we've got these crises showing up.
Well, I mean, the same thing happened in 2008 or 2007. We had the crisis begin on August 9th, all this stuff. We had funds blowing up, banks getting into trouble, Northern Rock. The Fed comes in and cuts the federal funds target by 50 basis points, and it sparked a rally. Shares actually got to a record high in October 2007. This was after the whole thing began, because, until it becomes obvious that this kind of thing is happening, most people are predisposed to buy shares and take risk. And so up until just the last week or week and a half, most people thought, well, what does this UK stuff have to do with me? There's some Swiss dollar auctions and credits. What does that have to do with US equities? So as long as it stays buried under the surface, and Jay Powell says, don't worry about it, and everybody on TV says, this is no big deal, as long as it stays hidden, everybody wants to be risk on, especially in financial services, where that's where they make their money. That's where they get paid. And then it's only when it really starts to become absolutely perfectly, unmistakably clear that things are going wrong, that's the point when everybody starts to get nervous and sell.
Yeah.
If you think Jay Powell is your friend, or when he's your friend, that's the time to buy stocks, it sounds terrific. The Fed pivot, that sounds awesome. That means no more rate hikes. We're going to get rate cuts. Shares should go to the moon. when you really need to stop and think about, why would the guy who wants to continue hiking rates to become Paul Volcker suddenly stop involuntarily and start cutting rates? That's not a friendly environment at all. But I don't think a lot of people think 2-3 steps ahead.
Well, yeah, and if you go back to 2000, I mean, I started in this business in '99, and I mean, I really didn't know anything at all when I first started. But what I do remember is, after the dot-com peak and started coming down, and they started cutting rates, and markets didn't go higher. They went down for about 2 or 3 years. And I remember, because I was just starting off in the business, and it was brutal. Like every day you'd come in and the stock market was down again, like literally every day for like 2.5 years. And they were cutting rates, and they were instituting programs, and and even in the 2008 and 9, from when they first started to do injections in QE, the market didn't take off right away. So if and when the Fed pivots, that's not a good sign, right? They're pivoting because, and I was trying to make this point over the weekend. The whole point of them pivoting is there's a hole in the economy, and they're trying to fill the hole. And if you hear the word QE, okay, they're throwing liquidity into the hole. That's great. But you don't know how big the hole is. So number one, they haven't done QE yet. They've done some injections, some loans. It's not QE. And number two, they're trying to fill a hole that they don't even know how big it is. So you've only got like not even half the battle won if you see them do something and all of a sudden you think it's QE. You got to be careful.
Yeah, I mean, that's where you look at the discount window, the primary credit, or the FHLB advances. If you see a huge spike in discount window, that's not a positive sign. That means that there are a lot of people out there who are not getting wholesale funding that they need. And there's probably a lot more who can't even show up at the discount window or get any funding. So Brent, that's the most important takeaway of I know you know this. This is the most important takeaway is that we don't know how big the hole is, and we'll never be able to know. That's why you have to look at market prices, because that's the only information we have. Quantitatively speaking, if the Fed is doing a lot, it's because that hole is a lot bigger than what the Fed is doing.
Guys, also
it's very counterintuitive. It's very counterintuitive, but because we've been trained to. And Jeff, you probably more than anybody have said they're just monkeys, right? It's all theater. It's the guy behind the curtain. And that's they've done a good job of training the public that when they hear Janet Yellen say something, or when they say Jay Powell say something, they're like, oh, go buy. And that's what they want you to do.
That tweet got a lot of engagement. I said, pre-election years are historically the best year of the presidential cycle, right? The strongest S&P stock market returns historically happen in pre-election years. The theory there is, well, the existing party wants to stay in power. The president wants to stay in power. So what do? They stimulate. So how do you stimulate the economy with high inflation? With a manufactured bank crisis, which, by the way, if you haven't noticed the balance sheet of the Fed, stimulus is now happening. The pre-election dynamic is there. So I do think you have a melt up. It could be a volatile one that surprises a lot of people by year end.
Why is it a manufactured bank crisis? What does that mean?
This is all known. People are making it seem like this is just suddenly out of nowhere. Credit Suisse has been failing since 2008. You look at a chart, it's been straight down, right? I mean, even with Silicon Valley Bank, the regulators knew it was in trouble. I mean, all this is now coming out now. It's not like this is like out of the blue. The timing, sure, you can say it's out of the blue, but that's what happens when you go through the fastest rate hike cycle in history.
Well, I believe a lot of big fund managers have owned Credit Suisse, not only stocks, but bonds. PIMCO, I believe, being one of them. Over $100 million per fund of worthless Credit Suisse bonds. I don't think they knew, Michael. Otherwise, they wouldn't have held them.
No. I would disagree. I think you can know that the dynamics are poor.
Okay.
But you don't necessarily know exactly when something's going to hit.
I
right?
see.
I mean, that would be kind of my point. And there's that great saying when it comes to markets: nothing matters until it matters, and then when it matters, it's the only thing that matters. Right? That's, I think, what largely explains Credit Suisse. But again, it's like these dynamics have been in place for a while. And again, I go back to, yes, the financial sector has gotten crushed. Yes, small caps have gotten crushed. But if it's a true risk-off period, every sector would collapse, and that is not the case for now.
Who manufactured this crisis?
I'm not a conspiracy theorist, but I do believe that sometimes timing is a little too coincidental. Like I said, the fact that this is happening early in a pre-election year to justify some form of stimulus puts us in the playbook, right? So I don't know. I mean, look, people might roll their eyes when I say that, and I'm not a conspiracy theorist by any means, but it's manufactured in the sense that the headlines make it seem so horrendous, but what we're down 3% off the highs for the S&P since this started. It doesn't make sense to me. The narrative is manufactured. I think is probably the better way to frame it.
I understand. So, but you're saying that there may be stimulus on the way?
There is stimulus now. I mean, a bailout is stimulus.
Oh, okay.
Right, pumping money. I mean, if you look at the balance sheet of the Federal Reserve, I mean, basically, it's Jim Bianco put out this tweet. It's like, I think it was 2/3 of quantitative tightening has been undone because of this, in quotes, crisis. This is how you get stimulus and high inflation.